when it comes to dividend growth stocks, I like using the WeeklyPay ETFs, such as BLOX, WPAY, and ULTY ETF to buy dividend growth stocks. Because dividend growth stocks, you get a raise pretty much. And during the pandemic, I did not get a raise being a nurse. So that was very frustrating. But allocating the income from ETFs, and yes, I'll probably rebuy ULTY a little bit, but I like WPAY a lot better and blocks and all that. But maybe ULTY may help a little bit with my dividend portfolio to buy these three dividend growth stocks, which I'm going to go over. They are really good companies. They have hiked their dividends. And again, I've been telling you this for a long time that dividend growth always wins, and dividend growth stocks always wins. Dividend growth investing always wins. And I stand by that because the ultimate plan is to get raises. Now you see sometimes the distribution of ULTY, WPAY, blocks isn't always the best. And these three dividend growth stocks have a really huge tradition in giving people an opportunity to retire on passive income because they feel very confident that they're going to get hikes. I see that all the time on X and social media. We're going to go over these three dividend growth stocks. So if you're new to this YouTube channel, make sure you subscribe and hit notification bell so you don't miss future videos. Smash that like button. Let's check out these three dividend growth stocks right now. Now looking at these three WeeklyPay ETFs, you see ULTY at 567, starting to maybe make a comeback a little bit. WPAY is doing pretty well. It's up 1.71% in the past 5 days. And BLOX is up 4.55%. So again, these three are not going to beat the S&P 500. And they serve a purpose for my dividend portfolio. And I'm going to say this again. Yes, I did sell ULTY. I'll probably rebuy it. Very glad that I sold it and put it into a little bit more stable WeeklyPay ETFs like CHPY and LFGY, and some of the distribution was allocated into really good WeeklyPay ETFs. But the thing is, what happens if ULTY has a split? What happens if WPAY takes a huge hit? What happens if BLOX takes a hit? Now, again, my confidence isn't the highest with these ETFs to retire on passive income. There's inconsistency. The market could take a tumble. ULTY is in some very high volatile ETFs. Crypto could take a hit. The weekly payers could take a hit. Remember, 120%. Things go up, things go great, things go bad, things go really bad. So again, I'm looking at consistency when I retire. That's the most important thing. And these three dividend stocks are consistent. Let's check them out. The first one I really like with my dividend growth section is Visa. V is a symbol. It's sitting at 341.61. Now, in the past 5 years, it was in line with the S&P 500. The S&P 500 is beating it right now, 102.04% to 73.19%. Now, you see this dividend yield is 0.69. Don't let that fool you. Now, don't get me wrong. I love high yield investing. I have a hybrid of high yield and dividend growth. But the purpose of using these high yield ETFs is to buy dividend growth stocks for the long term. And yes, it has done very well. And, I like the NEOS ETFs again a little bit more. They're more consistent for my retirement plan for retiring on passive income. But once I load up on these dividend stocks like Visa, you'll see why. So let's go over some earnings reports. Now, again, the nice thing with a credit card, anytime you swipe your card, like Visa or Mastercard, they make money. So there's a transaction fee that Visa makes. So they've done extremely well. And I'm going to go over their numbers. So for example, in July 29, 2025, Visa reported $2.98 earnings per share for the quarter ending in July 29, 2025, surpassing analyst expectations of 285. Quarterly revenue reached 10.17 billion, exceeding the expected and the anticipated 9.82 billion, and marking a 14.3% year-over-year increase. Analysts predict Visa will post 11.30 earnings per share for the current fiscal year, with an expected growth of 12.73 per share next year, representing a 12.65 increase. So that increases my confidence in this dividend growth stock and Visa as a company. Even more, its dividend growth history is fantastic. So here's an example. I'm using stockanalysis.com of its dividend growth. In February 2020, it was 32-cent distribution. And then in 2021, it was 37 cents. 2022, it hit 45 cents. 2023, it hit 52 cents. 2024 and 2025, it hit 59 cents. So you have a low payout ratio, which is nice. A dividend growth of 13.46%. The growth in years is 17%. So that is huge. The annual dividend, if you bought one share, is 2.36%. So again, don't let the dividend yield of 0.69% deter you because of a low yield, because look at the dividend growth of 13.46%. I feel very confident with companies like Visa who hike their dividends. Now let's check out the next dividend stock. And what a surprise! I mentioned Mastercard earlier. And again, when you swipe your card, they make money. They get a transactional fee. And you can correct me if I'm wrong. It's sitting at 584.16. In the past 5 years, it's been up 76.07%. The S&P's been up 102.04%. The dividend yield is 0.52%. So don't let that deter you from buying a dividend growth stock because the dividend yield is small, because it hikes its dividend and usually earnings reports are really good. The quarter results in 2025 and July 31st. The earnings per share, the adjusted EPS was 4.15, exceeding Zacks' consensus estimate of 4.05. I'm going to tell you, Zacks usually gives crazy numbers and estimates, and if they beat them, that's pretty serious. Net revenue, the net revenue rose 16.8% year over year to 8.13 billion, beating the 7.95% billion consensus estimate. Gross dollar volume, worldwide GDV increased by 9% year over year, reaching 2.6 billion. The key metric, which tracks the spending on cards outside of the country issue, grew by 15%. That's a cross-border volume. So you're seeing some really good numbers that are really good. The earnings per share have been up. The revenue have been up. Now let's check out the dividend growth history. I'm going to start in 2020. It was 40 cents, 2021, 44 cents, 2022, 49 cents, 2023, 57 cents, 2024, 66 cents, 2025, 76 cents. So we have a dividend growth of 15.15% in the past 13 years. It has grown. The payout ratio is 20.5%. That's a really good payout ratio. So it's less than 40, which is nice. The annual dividend, if you bought one share, it's $3.04 with a dividend yield of 0.52%. So don't be deterred because, again, a low dividend yield. That's why I'm like a hybrid dividend growth investor and a hybrid income investor, because you can't rule out dividend growth. I mean, I have SCHD for a reason, and I use, again, these ETFs to buy these dividend growers because, again, instead of reinvesting, I'm going to use that income to buy these dividend growers. And with my distribution of around 5,000 a month, I can start buying these juggernaut dividend growth stocks. Costco is another one. I considered buying Costco, but I think it's a little overvalued, and I have Kroger in my dividend portfolio instead. So, that's another place that's very busy all the time. Now let's jump to the final one. This one has exploded big time. American Express, in the past 5 years, it has destroyed the S&P 500. It's up 254.37%. The S&P is up 102.04%. American Express is 341.12. That's an attractive price compared to Mastercard. Its dividend yield is 0.96%. So again, with the earnings of American Express, which I'll jump to, so on July 18th, 2025, the earnings per share, AXP reported an adjusted earnings per share of $4.08, exceeding Zacks' consensus estimate of $3.86 by 5.7%. This reflects a 17% year-over-year increase when excluding the gain from the sale of a Certify in the previous year. The company's total revenues and net of interest expense reached a record of $17.9 billion, surpassing Zacks' consensus estimate of $17.7 billion, marking a 9% year-over-year. The American Express reported a net income of $2.9 billion for the quarter. So again, swiping. They make money when you swipe. Look, I really don't have a debit card. I use a cashback card. And my cards for gas, one of them's Visa, okay? It's one of the parties. And the other ones are mostly Mastercard. What a surprise. And American Express is right up there as well. So, those three companies have done extremely well. And I just showed you their numbers, and I'm going to show you the last dividend growth history of the dividend stocks that I mentioned, which is American Express. We're going to start in 2020, 43 cents, 2021, 2022, and then all of a sudden in 2022, it jumped to 52 cents. Then in 2023, 60 cents, and then in 2024, 70 cents, and then in 2025, 82 cents. So we have a dividend growth of 16.92%, a dividend yield of 0.96%, which is a little bit higher than the other two. The growth in 3 years, 3, so it's making a comeback. The payout ratio is 21.37%. That's a pretty nice low payout ratio. And look at the dividend growth. So we have these three dividend growth stocks. Just remember, swipe, dividends. That's my thought process. Look up transactional fees. That's one thing that's important, because remember, anytime, and if a business doesn't accept credit cards, well, I can tell you there's a local store in my area that refused credit cards and debit cards. Well, guess what? Nobody wanted to go there and they had to adapt. So that was one thing that changed very fast with them. And everybody carries a credit card. And just remember, transactional fees. That's my thought process. So I'm not giving financial advice for entertainment purposes only. I'm just being very straightforward with you. And you don't have to buy things because I buy things. I'll have a video for you tomorrow. You guys take care and have a good one. And I'm going to jump to my disclaimer. So as a reminder, this is a disclaimer. Do not use my YouTube channel for any form of financial advice. It's strictly for entertainment purposes only. Investing is a big risk. You can gain money, can lose money, so be aware and do your due diligence. Go to a financial advisor for financial advice. Go to a tax advisor for tax advice. You have to do your due diligence when it comes to investing. You can lose money. You shouldn't be buying things because I buy things. This is strictly for entertainment purposes only, and I'm very transparent with my passive income journey. Take care and have a good one.